Hi, I'm Kevin Shaji, and in this video, I would like to cover a company's financial reporting, that is major changes in reporting under Schedule 3 and audit report under CARO 2020 from financial year 2022 onwards. I won't be covering full changes, but I will be limiting to those changes that impacts the decisioning of investors and lenders. So what is the objective of this video? As I told earlier, this video covers changes in Schedule 3 and CARO that impact the investment and credit decisioning. So if you ask me whether I cover 100%, no. But when I cover almost 90%, yes, because most of the content, most of the changes that has happened impact the decisioning. So that's why almost 90% of the changes are covered. So let's start with the first item. That is creditors payable aging schedule. If you know the previous reporting, it will be in creditors, there will be only two reporting, whether it is to MSME creditors, whether it is other creditors. Now, there should be clear-cut aging analysis to be done for MSME, others, disputed MSME, disputed others, with aging less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. How this impact the decisioning? It helps analyst to understand the entities liability towards the creditors and the aging. It helps in deciding whether the company is having liquidity adequate, a company is having ability to repay the debt, and why the aging is so high, why there is a huge huge payable remaining. So that is important to be identified, and this helps in identification of such so the next major change is on trade receivable aging schedule. If you know the previous reporting under Schedule 3, we need to do aging analysis, less than 6 months, more than 6 months. On that, now it is a much more detailed reporting. First, we need to report on undisputed trade receivable considered good, undisputed trade receivable considered doubtful, disputed trade receivable considered good, disputed trade receivable considered doubtful. On that, we need to make not just less than 6 months, more than 6 months, less than 6 months, one classification, greater than 6 months up to 1 year, another classification, 1 to 2 year, another classification, 2 to 3 years, another classification, and more than 3 years, another classification. So it gives an idea to the investors and lenders on the receivable position. We'll be able to identify what is the current receivable position and whether recoverability can be easily determined. Now, if by seeing this, we'll be able to, analysts will be able to understand the debtors position and probe further into their recoverability. Next one. Now, in some situations in the financials of the company, there can be an immovable asset in the financials, but not in the name of the company. Earlier, such details of such assets need not be mentioned in the financials. Now, if the item is reflecting fixed asset or as immovable property, but that actually the immovable property is in the name of promoters or anyone, that should be clearly defined. It should be clearly disclosed. Also, maybe some situations where the immovable property is partly in the name of the company, jointly held by some other persons, that should be clearly disclosed in the financials. That is the next change. Then disclosure and revaluation of asset. Suppose we revalue the assets and if there is a revaluation of asset, that should be disclosed. Property, plant and equipment, the company shall disclose as to whether the revaluation is based on the valuation by a registered value as defined under Rule 2 of the company's registered values and valuation rules 2017. Disclosure on loan. Just one minute, I close this. Yeah, now it's visible for you. Yeah. Disclosure on loan advances to directors, KMP related parties. Now we need to disclose in financial statements what are loans to the directors, to the promoters, to key management persons and related parties. Who is related parties defined as the company side that you should follow. Now every company will be having some capital work in progress. Capital work in progress may be for installation of machinery or construction of building or such and such things. So we need to disclose the details of capital work in progress. If you see the existing financials, there will be disclosure of capital work in progress, but just a line item. There won't be breakup. Now what we need is we need a breakup. Means we following capital work in progress details shall be given. Less than 1 year, 1 to 2 years, it will how much 1 to 2 years it will take, 2 to 3 years, and more than 3 years. So there's a big clear-cut breakup of capital work in progress. So we can understand what all capital work in progress is there, how many years it is still in capital work in progress. This can be identified in the financials by this disclosure. This is very important for understanding the fixed asset position and why water assets still not capitalized. That is one of the major changes. Details of BENAMI transaction. This helps in understanding investors and lenders on the fraudulent transactions. Actually, BENAMI transaction is like transaction in the name of other person, but the transaction is done by one person, whereas the actual beneficiary is other persons. Like done for fooling the government or fooling the income tax department or in any other ways. As per BENAMI Transactions Prohibition Act, if there is any transaction violating the this act should be disclosed in the financial statements. How means that is an important change that is being done. Details of borrowing. Here, this is very important. Why? Because where every bank means most of the companies will take a working capital facilities with various banks, banks and financial institutions. When the company is borrowing from banks or financial institutions on the basis of security of current asset, in that situation, what we'll do? These companies will disclose the current stock position, inventory means debtors position, creditors position, all these details to the banks, maybe monthly, maybe quarterly. So that the banks will decide on the drawing power. Drawing power is nothing but understanding the total debtors plus inventories less creditors. On that they will be reducing margin, and based on that they will be arriving a limit which the borrower can utilize. So this bank will decide on the drawing power based upon the stock, debtors and creditors position given by the company. So now the auditor, now in financial statements, we need to we need to do a reconciliation between the books and stock statement. Stock statement means a document that is given to bank should be reconciled with the books. If there is a material discrepancy, we should be disclosing it. This is one of the major changes. It means that every quarterly, if any documents are shared with the banks, that should be complying with the books of accounts. So if there is a discrepancy, that should be disclosed with reasons. So what does it tell? Where the company has borrowing from banks or financial institution on the basis of security of current asset, disclosure shall be made whether quarterly returns or statement of current asset filed by the company with the bank or financial institution are in agreement with the books of accounts. If not, summary of reconciliation and reason of material discrepancies, if any, to be adequately disclosed. So this will be how it will be useful. First of all, I'll tell that every company wants a higher drawing power. So what the companies may do is they will have a tendency to show a higher level of inventory or high level of debtors, so that they will get a higher drawing power. But that may not tally with the books of accounts. So now, if there is a discrepancies, that should be disclosed in the financial statements. So this is a good check point. Willful defaulters. So if the company is coming as willful defaulters, as defined by Reserve Bank of India, then it should be disclosed in the financials. Where a company is declared as willful defaulters by any bank or financial institution or other lenders, such details of the default should be disclosed. Relationship with struck off company. A company is struck off by Reserve Bank of India, ROC, Registrar of Companies. Then, if we enter transaction with such a company, we should disclose the nature of transaction and balance outstanding from and to them. That's important. Then registration of charges or satisfaction of charges with the Registrar of Companies. Before explaining this, I just want to explain what is this registration of charges. Suppose company is taking a loan from a bank. In that situation, we will be taking securities, whether primary securities or collateral securities. The securities will be in the name of the company. So, an investor or another lender, if it's approaching to understand the financials, because for investment purpose, they need to understand what all securities are already in lien by various banks and financial institutions. This charge details is a very useful means by which prospective investors and lenders can understand that what all securities are already mortgaged with the previous lenders. So whenever a company is taking a loan, they should file certain forms to the ROC telling that we are taking loan. For this loan, we are giving security. Maybe it can be current asset, can be fixed asset, can be mobile fixed asset, maybe mobile fixed asset. This we are giving a security to these banks, and this details needed to be disclosed with ROC so that any prospective investors or prospective lenders can understand what all securities are already lien marked. What all securities are already lien marked, that can be found from charges details. So what disclosure is required as per this Schedule 3? Where any charge is to be created, means when bank has given loan and bank has told that we need the security, they are giving the security, but if the charge is pending to be created, that should be disclosed. Or another situation, if suppose company has repaid the loan. If company has repaid the loan, security will be given back. Means that will be freehold security. In this situation, charge to be satisfied. Means we should close the charge. If this satisfaction charge is not made, that also should be disclosed. So wherever any charges or satisfaction is yet to be registered with the Registrar of Companies, beyond the statutory period, details and reasons thereof shall be disclosed. So, as I told, whenever a company wants to take loan, company may be giving security to the lenders. And this while we give a company's asset to the lenders as security, they should file a ROC charge. They should file a charge with the ROC. If that is not done, then it should be disclosed. And if suppose a loan is repaid, then we should satisfy those charges. We should close the charges. That also to be filed. If that is not done, that also should be disclosed. Disclosure of ratios. This is an important change. Now, previously, if a lender or an investor want to analyze a financial statement, they can see the balance sheet, they can see the P&L, but if they want to further dig deep into the financials, means by comparing various ratios, decision-making ratios, they need to do manually by making an Excel sheet. Now, financial statement itself is disclosing many ratios. These are the ratios: current ratio, debt equity ratio, debt service coverage ratio, return on equity ratio, inventory turnover ratio, trade receivable turnover ratio, trade payable turnover ratio, net capital turnover ratio, net profit ratio, return on capital employed, return on investment. Explanation need to be given if change in the ratio is more than 25%. If there is a change in ratio more than 25%, then that should be disclosed. This is a welcome change. This will be very useful for the lenders and the investors, because they can, instead of putting everything into Excel sheet and making a ratio analysis separately, they can directly look the ratio analysis in the financial statements and thereby make a decision at a more faster rate. Compliance with number of layers of company. Here, as per Indian companies rule, there is a restriction on number of subsidiaries that a company can have. So a company if means if there is a holding company, they cannot have more than 2 layers. There is exceptions to this for some sector. So this, if they are not following, that should be disclosed. Where the company has to comply with the number of layers prescribed under clause 87 of section 2 of the Act, with companies restriction number of layers rules, name and sin of the company beyond the specified layer, and the relationship extent of holding of the company's downstream companies shall be disclosed. So if they have so many subsidiaries, so many layers of subsidiaries beyond the permissible limit, that should be disclosed. Okay, next one is this I will give it. If the company want to take a loan, company will be taking loan for a particular purpose. If they are using for that particular purpose, that's well and good. Suppose a company has taken loan from bankers by telling that I will be using for a particular purpose or for purpose A, but used for a different purpose, that is purpose B. That is like a cheating. It is not communicated to the lenders. That is not fair. So, where borrowed fund is utilized for purpose other than the purpose as listed, that should be disclosed. This is not for only borrowed fund. Suppose they have, this is also for capital. Suppose they have raised capital, and for raising capital, they might have told some purpose, but that is not, the utilization is for a different purpose, that should be disclosed. Now I explain. This transactions where an entity has provided an advance loan or invested fund to any other person, entity, or entities, including foreign entities. Transaction where entities received any fund from person, entities, including foreign entities. All the situation they utilize for a different purpose, it should be disclosed. So here we are getting the money, we are investing in subsidiary companies, but we are told for other purpose. That is wrong. That should be disclosed. That is what is mentioned. Compliance with approved scheme of arrangement. Actually, while investor or lender make make a decision, they will be understanding of all the say like their amalgamation, their future amalgamation or restructuring. All the schemes they should be well aware. They should be an investor or lender will be deciding based upon the future cash flows and future investments and future activities. So where there is a case, so this and now what for their guidance, this is introduced, means we in financial statements compliance with the approved scheme of arrangement should be disclosed. Where any scheme of arrangement has been approved by the competent authority in terms of 230 of 2007 Corporate Restructuring of Companies Act 2013. Company shall disclose that if such scheme of arrangement have been accounted for in books of accounts of the company in accordance with the scheme and accordance with the accounting standards, and deviation in this regard shall be explained. If there is an amalgamation, there is any demerger, or there is any restructuring in any form, and it's impacting financials to disclose as per standards, as per the scheme, and any deviation should be disclosed in the financials. Suppose, this is an interesting thing. Suppose company is disclosing income as per financials, but one day income tax people come raid the company. They found some undisclosed income. If the income tax department has found some undisclosed income, that should be disclosed in the financials. Company shall give details of any transactions not recorded in the books of account, surrendered or disclosed as income during the year on tax assessment. So, as per income tax, if they have disclosed a higher income but not in the financials, that should be disclosed. Others, these are not much impacting the decision making. That's the reason I didn't tell much. The crypto transactions, if a company is into crypto transaction, we should be in caution actually. That's just impacting. But if the company is all CSR expenditure need to be disclosed. Number 2, crypto transactions to be disclosed. Crypto transaction, if any crypto transactions are there in the financials, analysts should be cautious. You understand the transactions because it's mostly speculative as of now. Next one is total revenue replaced. This third one is like previously financials, total income will be mentioned as total revenue. Now it is replaced with total income. That is the change that has happened. So these are the changes that has happened for Schedule 3 of the financial statements. This is applicable from financial year 2022 onwards. If you have any doubts, please do comment in the comment section, where I'll be happy to guide you. Now I will be covering changes in reporting as per CARO 2020 that also impact the decisioning of financial investors as well as creditors, lenders. Sorry. So there are many changes in CARO also. That is what I'm going to cover. Okay, first one, major. Just 1 minute. Sorry. Extremely sorry. Yeah, major content influencing credit and investment decision in CARO is what is being covered now. Details of investment, any guarantee or security or advance or loans given, details to be given. If a company has made an investment or any guarantee or security or advances, should be disclosed. Compliance in respect of loan to directors. Actually, if you are giving a loan to directors, that should be as per certain rules of the Companies Act. If there is not compliant, that should be disclosed. If there is unrecorded income, that is disclosed in the financial statements as per Schedule 3. Now that should be disclosed in audit report also. If there is a default in repayment of borrowing, that should be qualified. That should be mentioned in the CARO report by the auditors. Funds raised in utilization. Actually, if a company has raised the debt and if it is not utilized for the purpose it is raised, then auditor also should disclose in the CARO report on this matter. Fraud whistleblower complaints. So, a company as per the Companies Act, there should be whistleblower policy. Means an employee, if he finds a fraud, that should be he should be free to communicate that to respective authorities to prevent those fraud. So if what auditor should do is if there has been a fraud by the company or fraud done by on the company, in such situation it has been noticed and reported at the time of the year, then nature of such fraud should be disclosed in the CARO report. Where the auditor of the company has filed report. Actually, if fraud is disclosed, then auditor has to file a report called ADT4 with the central government. That is done or not should be disclosed. In case of whistleblower, if any complaint from any whistleblower complaints are received, that also to be considered by the auditors while reporting under this CARO. If the companies will normally enter into transaction with related parties, that can be subsidiary companies, that can be group companies, that can be companies interested by the directors, etc. If such transactions are being entered into, whether they complies with the laws and regulations to be disclosed in this audit report. Then internal audit system. Now here this is important. If actually internal audit will be done by separate team, statutory audit will be done by separate team. So now statutory auditor should comment that whether the company is having adequate internal system in control with the size of the business, whether they have internal control system, internal audit system, and whether the internal audit reports have been considered by the statutory audit for their reporting. That is to be disclosed. Now, has the company incurred any cash loss in the financial year and the immediately preceding financial year, the amount of cash loss incurred should be disclosed. If there is cash loss, that should be disclosed. Then resignation of statutory auditors. Whether during the year has there been resignation by statutory auditors, if yes, has the auditor considered the objection issues and concern raised by the outgoing auditors. In some, what happened? I'll give an example. Suppose at the beginning, one auditor is being appointed, but auditor is refusing to sign the financial audit report by raising some objections or objections in financials. He may not be satisfied with the audit evidence that is obtained because maybe because of some irregularities or whatever reason. In such situations, auditor may object to sign the audit report, or auditor may decide to give a qualified report or an adverse report. Or auditor will tell that he is unable to give opinion on the financial statements because he doesn't have an appropriate or sufficient appropriate audit evidence. In such situation, management may decide to change the auditor. So what will do? The existing auditor will resign, and in place a new auditor will come. If the new auditor comes, then he has a moral obligation as per the auditor standards to communicate to the existing auditor and understand the reasons why the existing auditor has left. Also, as per CARO, if there is a change in auditor, then auditor should consider the objections, issues, and concerns raised by the outgoing auditors. And he should also communicate in the CARO report that he has considered those objections, issues, and concerns in the current audit procedures. Next one, qualification or adverse audit remarks in other group companies to be considered. So there can be multiple group companies, subsidiary companies, all these things. If there is an audit qualification, that should be communicated as per CARO report. Then next one is material uncertainty. This is like interesting thing. This is a newly introduced thing. As on date of audit report, auditor should do an analysis that for the next 1 year, companies having adequate ability to repay the existing debts. Existence of a material uncertainty on the date of audit report, on an evaluation of aging report, on the basis of value aging report, financial ratios, as per the date of realization of financial assets, payment of financial liabilities, any other information accompanying financial statement, auditor's knowledge of the board of directors and management plan, opinion whether the company can meet its liabilities which exist at the balance sheet date and such liabilities are due in future. So in the balance sheet date, there can be some liabilities. These liabilities, whether next 1 year, whenever next future, whether the company is able to repay next year based upon the what all information, based upon the aging report, financial ratios, as per the date of realization of financial assets and payment of financial liabilities, all this to be checked, including director's report. Auditor can give opinion that the company is able to meet the liabilities in future. This is like a future cash flow analysis. An analysis of financial difficulty that company may arise based upon the future obligation and future cash flows. This is another major change. So these are the changes that is happened in Schedule 3 and CARO, which mostly impact the decisioning of investors and lenders. If you find this video interesting, please like, share, and subscribe. And if you have any doubts, please do comments in the comment section. Thank you.